Hey everyone, now that we've turned the corner on 2022, today I'm going to be talking about the top 3 stocks I'm going to be buying in 2023. Now, before we get into the video, I just want to ask everyone that enjoys this type of content to consider subscribing to the channel. We finally hit 10 subscribers, hoping to grow it from here. I also would love, if you like this video, if you show me by liking and commenting on the video. Would be very interested to hear what stocks you're planning on buying in 2023, or your opinion on the stocks that I'm planning on focusing on in 2023, as well as if you own any of these stocks or have any opinion on them. Would love to hear your opinions as well. Let's get into it. Okay, so before we're going into the specific stocks, these are some of the industries these stocks fall into. The first one is a bank. I think banks overall have been hit really hard because of people concerned about an upcoming recession. But I think lots of the highest quality banks are trading at very, very reasonable and frankly undervalued earnings multiples and have just been hit too hard, frankly. So I think regardless if we go into a recession or not, the banks are poised for good long-term growth as long as you're picking the quality ones. A big tech company, once again, not all big tech companies are created equal, but I think there are some that have been hit really hard last year. And as we kind of go through what may be a recession this year and get out of it, hopefully in 24, there's some that pose pretty good value relative to what they have in the past and given their business models. And lastly, a fintech company that has also been performing really well, but not necessarily getting the benefit of the doubt on the share price. So let's get into the first stock here. The first stock that I want to add to in 2023 is TD Bank. Now, for those of you who aren't familiar with TD Bank, TD Bank is one of the largest banks in Canada, largest on assets and deposits, second largest behind RBC on market capitalization, but it's also one of the biggest banks in North America. Fifth biggest bank in North America on all assets, deposits, and market cap. This is really driven by both organic, but also a lot of acquisitions they've been making over the last decade in the US. They primarily play in the north and the east of the US, but they've really built a really big business. I think they have more branches in the US than Canada now. So that's a really impressive feat given where this company was 10 years ago. And that's really where they're focusing on for a lot of their future growth, as it's just a much larger market than their home market in Canada, obviously. In terms of TD's revenue mix, one of the reasons I really like this bank is they're not highly exposed to very volatile banking revenue like capital markets for the most part. 40% Canadian commercial banking, 30% US retail banking, and then 30% split up between wealth management, insurance, wholesale, and then also their equity investment that they have in Charles Schwab behind their merger with TD Ameritrade, I believe. So this is revenue that typically is a bit more sticky on the commercial and retail banking side, which is really the majority of the company's revenue and also profit. I also like how they have that diversification between Canada and the US. Even if there's a global recession, Canada and the US tend to differ in terms of how deep into recession each country goes. They each have different kind of economic landscapes to a certain extent and what sectors each of those countries are exposed to. So puts a bit more diversification in the business across the two countries. Now, this is something I really like about TD, and it's one of the things I was alluding to earlier on focusing on really high rated banks. So on a rating standpoint on their debt and their loan to values, TD outperforms both their Canadian and their US peers. It's much harder to get a loan at TD relative to many other banks. In Canada, I know that lots of people are unable to get loans at TD because they have such a high bar and you need to have so much liquidity, capital, credit history, put so much down, whereas some other banks that aren't big banks will take you on less money down, less credit history, but TD's book is really creme de la creme. Even though things have gotten a bit more dicey, their provisions for credit loans have gone down like 4 basis points, which is essentially nothing. So even if we slip into some headwinds economically, I think TD's books are positioned very well for it not to be a dramatic hit to their earnings and their PCLs. Now, looking at the company's highlights for 2022, I just want to focus on their EPS essentially. So, in addition to revenue and profit being up double digits here, their EPS is about $9.50 in Canadian dollars. Their share price is about $88. Now, depending on if you're looking at adjusted EPS, non-adjusted, GAAP, non-GAAP, whatever, the PE of this company currently from 2022 is anywhere from 9 to 10.5, 11. So let's just call it about a 10 PE trailing. Some of the drivers they have for next year, they are counting on still organic growth on their core business, as long as no surprises from a macro standpoint occur. But throwing that aside, they have a deal in place to buy First Horizon, I believe almost entirely in cash, which should drive double-digit EPS growth as is, because I think it'll be about 1.5 billion add to net income, which is about 10% of what they were in 2022, with no dilution on the share side. So right away, before you even look at organic growth opportunities, this business should grow EPS 10% next year behind closing that acquisition in cash. They also, this is less of a driver of earnings, but more of just nice to know for their US strategy, acquired Cowen, not exactly sure the right pronunciation. I've heard it both ways, which is, I think, a capital markets company for $1 billion out of New York, which just goes to show they're continuing to invest in the US. They really see that as their growth driver moving forward, given the size of that market, relative to Canada. So the company's trading at a 10 PE. They have acquisitions in the pipeline that are going to fuel that. They also have organic growth projected on top of that acquisition growth. And they've been really good at returning money to shareholders through dividend increases, averaging a double-digit annual growth rate on their dividend. Last month, they just increased it again, 10%. Their current dividend yield is about a 4.4. This is a bit dated since they just increased the dividend recently, and the stock price has gone down a couple percent as well. So overall, I just think this is a really solid business, long track record for strong growth, paying a 4.5% dividend and still retaining over 50% of the company's profits before acquiring a business that's about to deliver an extra $1 to $2 billion of incremental net income, which they'll ultimately likely buy back more shares with or buy more businesses with, which is just going to spit out more and more cash flow. So I think this business is very well priced given the high quality and the good track record of it. And that's the reason that I'm really looking forward to adding to TD in my portfolio, which is already a very large position for me. The second stock I'm going to be buying more of in 2023 is Alphabet. So this is just a chart here, and I want to highlight the bottom and the source timeline. This is from June 2021. So try not to take the actual growth rates here with any knowledge here. It's just more to show all the different industries that Alphabet plays in from a digital ad perspective, and they tend to be growing over time. I don't like looking at like 1 year versus another, but generally speaking, lots of digital ad spend or lots of ad spend and incremental ad spend as businesses grow are going to online and digital ad sales. So whether that's on Amazon, if you're retail, Google across the board, Facebook, Meta, whatever you want to call it, this category of digital ads is just growing exponentially over the last 10 years. It really blew up during the last few years. So it's stalling a bit now as reality's catching up with that growth rate, but also we're facing some potential macro pressures. But long term, I think this is a trend that will continue. And it really isn't counting on one area of the economy specifically. You got, so list off a few here. You got telecom, retail, insurance, healthcare, entertainment, CPG, computing, banking, automotive. So it's across the board. As certain sectors grow and others decrease in the economy and in relevance, Google's kind of protected from that since they're really providing digital ad services across the board. So I think they're very diversified from a client perspective and a geographical perspective as well, which is why I just really like this business. Very well diversified with a very riding a very good trend of growth in the ad space. Now, a much smaller part of the business, but their cloud business is still unprofitable, but quarter over quarter, it's getting slightly less and less unprofitable. And I think it's only a matter of time until one, the cloud business stops becoming a bleeder for the business, and then maybe longer term actually becomes a part of the business that adds to the bottom line. But going from losing billions of dollars a year to flat is still going to be a big EPS help for the company. So I still want to talk about it a bit. You can see here how vast and how wide their customer their customer portfolio on cloud is. I won't list off all these names, but you're seeing very big companies from Americas, from all over the world here that are partnering to some degree with Google Cloud. So they're getting a lot of traction, a lot of momentum. And as they continue to acquire more companies in their cloud business, they just acquired a security company, a cybersecurity company. That's the word I was looking for $4 billion last year, and roll these in and really cross-sell. This will be a more and more profitable area of their business. And I think they finally found one area, despite all their investments in many different areas, one area that they can actually add a second profit center that doesn't have anything to do with advertising to their business. So this is not priced into the value in the PE at all, since it's still losing money, but something that I think may be a small tailwind in the medium to long term for the business. This is just showing their revenue CAGR and growth rate of cloud. So it's starting to get to the point that this is a relevant amount of revenue for the business, and they continue to kind of grow share as their growth rate is going faster than the category. They're still much smaller than Azure, which is owned by Microsoft, or AWS, which is Amazon. But as long as they're continuing to grow and outpace the category, given what their valuation is and that this isn't priced in at all, I think this should, help the stock by at least adding some dollars to the bottom line instead of being such a drainer that it is today. So it's something that I'd like to see them investing in and focusing on instead of just being a pure play advertising business, given their absolute market cap and some of the potential issues that may come in the digital space and with Congress and stuff like that in years to come. So going into their numbers here, they've continued to grow their search business up to $40 billion from 38. On YouTube, they actually had, I think they just had a very strong base they were talking about on the conference call. Lots of online businesses had very strong years in 21. It was very hard to comp that. Also, lots of cryptocurrency ads, stuff like that. I'd still say the business is pretty healthy. I'm not too concerned over the long-term growth rate from this $100 million dip in YouTube ads, but it's definitely something I'm going to be watching this year. Ultimately, the business is doing about $70 billion in revenue. One thing that I want to definitely keep an eye on is number of employees. They're adding employees and SG&A costs at a faster rate than revenue growth. So I'm really hoping in 2023 they begin to pare that back. Given the expected growth rates of the business, I don't think it's sustainable to be increasing employees to a degree that's significantly higher than that. If anything, they should be having operating leverage on their existing employee base. So that's something I'm going to keep watching. But this is just what I was talking about down here. In terms of operating income, they're making $20 billion from Google search, um, this is Google services. So this probably also includes their YouTube business and everything else. So $20 billion from advertising, losing 1.6 billion from other bets, which is just a frustrating part of the business that they don't really know what the plan is for it. It's just been burning billions of dollars a quarter for the last decade, which they could have been investing in, profitable endeavors. But I'll just let that one be. And Google Cloud here, where we're talking about minus $700 million. So on an absolute basis, losing a bit more than a year ago, but it's really stabilized. And on a margin basis, they've have sequential quarter over quarter growth in their margins over the last 3 or 4 years. So I think this will ultimately flatten out, hopefully in 23, if not 24, and should stop hitting the bottom line as a negative couple $1 billion. In terms of their current assets are about 116 billion, their total cash is 116 billion. Total assets about 166 versus 188 in total debt, whereas their total liabilities is about flat at 65 billion. So they've been a lot more aggressive on buying back shares of the company, which is probably why they have a bit of a net hit on their total current assets, at least, of about $20 billion. Some of this isn't fully being represented in their total share count because they're just hiring so many employees, giving them stock options. So I'd really like to see that kind of level out so we can see the value be passed to shareholders from all the share buybacks that they're truly doing. That's one of the main things I'm looking at the stock in 2023. With that being said, I just think for the quality of this business, Google search is such an effective and productive business. It's almost a must-have and increasingly a must-have investment for brands and businesses, small, medium, large, across the board. Very sticky. It's less prone to privacy regulation since you have consumers coming to you proactively typing in what they want and what they need and what they're looking for, versus Facebook that's kind of relying on you telling or them kind of extracting that information from you based off of how you use the service. So I just think they're just positioned in a much better spot in the digital advertising space than Meta. And at EPS of, let's call it $5, trading at under 90, the PE's under an 18, even though they have over $100 billion, about 10% of their market cap sitting in cash. So if I strip the cash out of the company, this is trading at a mid-multiple, 16, 17 multiple trailing. And looking ahead, it's probably trading about a 15 multiple. Google over time, I know it's a lot more regulation and stuff right now, but it's traded at a 30 times multiple. And this is a year that they've actually been hit a bit with crypto and stuff like that, advertising going down. And despite being hit a bit, they're still trading at a very reasonable multiple with a lot of cash on hand, a cloud business that just by getting to break even is going to deliver an extra dollar to the bottom line, if my quick math in my head isn't wrong. So I think there's a lot of things going on here on their business that can serve as growth. And then just long term, I think the business is well positioned from how well diversified they are. Their search business, YouTube, hopefully incoming cloud revenue. One of my pet peeves is, once again, other bets, any short or long term road to at least break even or profitability would be helpful. Obviously, it's been a decade and they really haven't delivered any value for shareholders out of that. So that's frustrating. Employee count is something I'm going to be looking at, and just total dilution of shareholders from all the stock options they're giving internally. They're wiping it out by buying back shares and then some, but I'd like to see those share buybacks flow through to the shareholder a bit more. And then just regulation with the government and privacy, seeing how that affects this business. I don't think, once again, they're going to be hit as hard as potentially some others, but still worth keeping a note of. And the third stock I'm buying in 2023 is Visa. So I've done a much larger analysis on Visa stock and Visa shares. So if you want to know more about my thoughts on Visa, or just go through their business a bit more, I'll link that video in the description. But just to provide a quick summary, this business provides about $20 billion of cash flow, essentially a royalty on the global card economy. As people are using their cards, they're getting a couple percent here, a couple percent there, flowing up to about $20 billion in cash flow after they pay their expenses. Their capex is essentially nothing, about 5% of that. So this is just printing money, about $18 billion in 2022, should be even more in 2023. They're taking all of that money, buying back shares, paying dividends. They just increased the dividend 10% again for 2023 and re-up their buyback program, I believe. So this is a business that has a huge moat, very strong relationships with banks, and I think is just based off historical valuations and at a very good price today. Similar to just what I was just talking about, their growth rate over time, 11 trillion in total payment volumes to 13 trillion to 14 trillion this year. Next year should be over 15 trillion. So it's just a big trend of consumers moving to cards. I believe the vast majority of the global economy is still in cash, which is, not the most efficient and convenient for consumers or for businesses. So I think it's just a matter of time until the world moves more and more to cards. Even Apple Pay and paying through phones and stuff like that tends to go through Visa's network. And they've done a really good job at flowing this increase on just top line payment growth into net revenue growth, 22 to 24 to 29 billion, and then that into EPS growth through $5, $6, $7. Net income, obviously a byproduct of or a feeder of EPS, same thing, 11 billion, 12 billion, 15 billion. So this business just has very sound structural economics, riding a very big growth trend with very low capex payment. This company, as we talked about, return to shareholders on some of the other stocks, is one of the best in the world of just returning dollars to shareholders. They don't need to go off and invest in other bets like Google or stuff like that. They're just very focused on returning money to shareholders through doing buybacks and then increasing the dividend as they grow your share of the company and then also grow the presence of the company globally in lockstep. So this is just a great chart over the last 12 years of them essentially cutting their share count in half while exponentially growing revenue and profit. Really shows how they're really focused on delivering value for the shareholder. Anyways, those are the three stocks that I'm looking at buying a lot more of in 2023. Let me know your thoughts on any of these names. Would love to hear your opinions. Would also love to hear what stocks you're planning on buying in 2023. And once again, if you haven't already, would love if you subscribe to the channel, consider liking the video. It all really means a lot, and Happy New Year.